It's been another important week of economic updates, everything from retail sales, consumer expectations, to housing and manufacturing. Let's break it down and get you up to date. Before we begin, remember to like this video and subscribe for more economic updates. You've probably heard a lot of talk about the economy, and this week's numbers didn't disappoint those hoping for good news. Consumer spending for September was one of the most anticipated pieces of data, and it looks like the optimists got their wish. On Thursday, the Commerce Department shared some solid numbers. Retail sales jumped by 0.04% for the month. That's even better than economists' predictions of a 0.3% increase, and a nice leap from the slower growth we saw in August, which was just 0.1%. When you exclude auto sales, the numbers got even stronger. Retail sales surged by 0.5%, far surpassing the modest 0.1% gain economists had predicted. Analysts are saying this steady stream of stronger-than-expected retail sales is building a case against the recession fears that many believe were already locked in, especially after some signs of weakness in the job market. And now, with the economy showing more life, there's talk that the Federal Reserve might hit pause on its plan to cut rates if things continue heating up. Switching gears a bit, we got some news that hits closer to home for many Americans. A recent report from the Federal Reserve Bank of New York shows that more and more people are worried about missing their minimum debt payments over the next few months. In fact, according to the New York Fed's latest survey of consumer expectations, the perceived chance of missing a minimum payment rose to 14.2% in September. This marks the fourth straight month of increases, and it is the highest level we've seen since the height of the global health crisis back in 2020. It's not just debt payments worrying people either. The survey shows that concerns about future inflation are creeping back up. While expectations for inflation over the next year held steady at 3%, the longer-term outlook is shifting. The 3-year inflation outlook increased to 2.7% from 2.5% in August, and the 5-year outlook inched up to 2.9% from 2.8%. Also this week, it appears that when it comes to the chronically anemic manufacturing sector, what goes up must always come down. In yet another sign that the U.S. manufacturing is having a tough time building momentum, the Empire State Manufacturing Survey from the New York Fed showed a sharp 23-point drop in October. This puts the index right back into contraction territory. Just last month, things looked more promising when the index jumped 16 points to reach 11.5. The first time since November 2023 it moved into positive territory. But this month, it took a steep dive all the way down to negative 11.9. Two key metrics driving this decline were the new orders index, which dropped by almost 20 points, and the shipments index, which fell by nearly 21 points. Now let's turn to the real estate market. On Thursday, the National Association of Home Builders reported some positive movement. Its housing market index rose for the second month in a row. The index gained 2 points in October and landed at a reading of 43. This rise in builder sentiment seems to be more forward-looking, especially given the ongoing affordability challenges. However, industry experts believe conditions are set to improve as inflation cools off and interest rates continue to decline. The Housing Market Index, which measures sentiment on a 1 to 100 scale, is still 17% below its historical average of 52, and nearly 50% lower than the levels we saw during the post-global health crisis housing boom in 2021. And finally this week, big news from across the pond. The European Central Bank did exactly what many were expecting, cutting interest rates by another quarter point. This marks the third 25 basis point cut since June, bringing rates down to 3.25% in the Eurozone. Just a month ago, most officials didn't think another cut would come so quickly. The general belief was that the ECB would hold off until December after more economic data rolled in. But concerns over a slowdown in the private sector shifted that thinking. Another big reason for the cut is that inflation in the Eurozone is cooling off faster than expected. In September, annual inflation dropped to 1.8%, dipping below the ECB's 2% target for the first time in 3 years. That wraps up this week's Economic Breakdown. Make sure to join us on Monday, where we keep you up to date on all the latest developments. This is Devlin Steele for Augusta Precious Metals signing out.